U.S. natural gas futures traded around $2.20 on Thursday, following a 6% loss in the previous session, as investors continue to monitor weather forecasts ahead of a federal report expected to show utilities injected more gas into storage last week than usual. The U.S. Energy Information Administration said natural gas storage inventories for the week ending April 14 increased by larger than normal 75 billion cubic feet, indicating that supply-demand balances remain far too loose. Looking at total degree days, we had a bunch of near-record low demand days, so this could have been worse really. It was warmer than normal over much of the lower 48, besides the northern plains and northwest, during the EIA reference period. Next week's EIA report will be factoring in exceptionally light demand the past 7 days for a much larger build versus normal. An injection in the 70 billion cubic feet range for the week ending April 21 would compare with last year's 41 billion cubic feet increase in the same week last year and the 43 billion cubic feet 5-year average. Despite a drop in preliminary daily output and U.S. LNG export plants expected to hit a record high for the second consecutive month in April after Freeport LNG's export plant returned to service in February, U.S. natural gas futures still fell by approximately 5% on Wednesday. This was due to forecasts confirming that the weather will remain mostly mild and heating demand will remain low for the next 2 weeks, resulting in a decline from a 1-month high in the previous session. Starting Thursday, there will be a swing back to light national demand as warm break sets up over the southern and eastern halves of the U.S. From a daily technical viewpoint, natural gas is trading below the pivot at $2.35. Overtaking the pivot will be a sign of strength that could extend the rally over the near term into $2.60. Meanwhile, a sustained move under the pivot will indicate the presence of sellers.